Now, according to the International Monetary Fund, IMF, currency devaluation is a deliberate downward adjustment in the official exchange rate, which reduces the currency's value, while when market forces generate changes in the value of currency. Currency devaluation can present significant drawbacks ranging from expensive imports, higher inflation, as well as declining local consumer purchasing power. It can also result in less efficient and less competitive domestic industries in the medium term. Well, let's talk more about this and the implication for the Naira. And I'm being joined by Portfolio Manager. He's with AIRFARES West Africa, Mr. Babajide Atolagbe. Mr. Atolagbe, thank you so much. It's good to have you on the program.
Hi, good afternoon. It's my pleasure.
Yes, I'd like to start with all of these bold steps that everyone commended, talking about allowing the free flow of the Naira, all of this iron window and the black markets, trying to open up the market. Many would say that it's neither here nor there, looking at the challenges that we face as a country. As of today, the dollar is above 900 Naira in the other market. And everyone is saying, what is happening because of the ripple effect of this on other expenses or anything you're buying across the board? What is your understanding of this policy and the impact on the Naira?
Yeah, thank you. The policy is actually a very, a much needed policy that the country needs to, change the economic trajectory of the country, right? Over the years, we've seen, monetary institutions like IMF, World Bank, and even top economists complain about some of the issues of the Nigerian economy, and some of them have been centered around the subsidies that the government have, been running before, that is completely unsustainable and that is not helping the country to achieve the inclusive growth it wants to achieve. So for the policy we've seen, being rolled out in the first 2 months of this administration has been, the policy we need. However, policies are not cheap, right? They come with some, effect that has to, be taken by, the general public before we can begin to see the positive side of the policy. And the case in point is the, the FX situation in Nigeria that we're speaking of currently. I mean, following the attempt to unify the market into one single market, right? The CBN devalued the official exchange rate from about 460 naira about to about 760, 770 band, right? And this adjustment was, done in order to unify the market and then put the market closer to put the exchange rate closer to what the market is basically pricing it at. But we've seen a situation where after that policy has happened, the parallel market has gone further in terms of moving from like 790 naira to about 890, 900 thereabout. And this is simply as a result of the supply-demand imbalance, right? We understand that the CBN wants to have an harmonized exchange rate forum where all market participants can play. But don't forget that for you to have an efficient market, you need to have supply to meet up with demand. And a lot of people have come to, talk down on the central bank, saying that they have, done the wrong policies, or the policy is not in line with, what will bring the economy back to it, But the policy is actually the right policy, just that there are some technical imbalances with how the policies are being managed. The case in point is the CBN supplying FX to the market, right? We have people who are trading at the iron window at 770, 780. And don't forget that there are some items that are completely banned from the iron window, which means those 43 items have to be sold from the external market. And if you look at the list of these 43 items, these items are items that on a typical day, Nigerians need about 60% of that item in terms of consumption. So people need to actually, get FX to import those products. And, based on that pressure, people are now moving to the parallel market. And the parallel market, it's a market whereby those who have these currencies, they are preying on the desperation of those who want these currencies. It's just very simple. When demand completely outweighs the level of supply, you find it difficult to actually catch prices. However, how can this be, addressed? It can be addressed in the sense that the government has to now find, ingenious ways to like increase supply into the economy. And how do we increase supply of FX into the country? And we have about three major sources of FX inflow into the country. And the first one is through foreign portfolio, foreign capital importation. Second is through exports, and then the third is through remittances. And then CBN can also explore raising money from the Eurobonds market. But if you look at all these channels, which of them can bring in FX into the country very, very quickly? And my first guess will be exportation. Nigeria is very big on exporting oil, right? But if you look at our production numbers, over the last couple of months, it has been nothing to write home about. Our aggregate production has fallen from about 1.6 million barrels per day, 1.6 million barrels per day to about 1 million barrels per day, which is completely uninteresting. And this is because of the thefts and all those production challenges. So the amount of money we're able to accrue from the export of oil has moderated, it has dried up, right? So it is one of those forces that is adding to the imbalance in the supply and in the supply demand market, and thus you begin to see exchange rate problem going very, 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 out of hand. I mean, we're currently at 900 to the dollars at today, and it is not an interesting story as we speak.
I must tell you, it's not an interesting story at all, seeing the dollar at to Naira rate that high. But some also talked about importing of PMS. Many marketers at the moment want to bring in products because the market has been opened. NNPC used to be the sole importer. So that, like I asked my other guests, and some think that if we have in-country refining, we might reduce this pressure on the greenback. Do you agree?
Yeah, I mean, if you look at if you break down the import numbers into Nigeria, you notice that PMS actually account for a substantial part of what is imported into the country in a day. So, I mean, it is crystal clear that if we cannot, necessarily control, supply, what we need to do is actually control demand, because if we cannot control supply, we need to actually control demand. And in controlling demand, we need to look for alternative means to start selling PMS to the general public, other than looking outside the shores of Nigeria. Right? And that is one of the major moves that is completely welcomed to the Nigerian economy, which is the Dangote refinery. We can see that based on the projection, the refinery is expected to cushion that level of importation into the country. So, I mean, we need more alternatives, and if we have more importers, that will just put more pressure on the FX situation. But if we begin to rethink about the domestic refineries, having all those refineries that are being not working efficiently, we can channel funds into those spaces to like mobilize them. We begin to have a situation whereby Nigeria is able to have some level of cost savings from PMS importation, because domestic capacity can now cater for what the market requires.
Let's move on to talk about inflation, which is also biting hard, not only in Nigeria, but even in the United States. We saw the figures out yesterday, and it's so high, and everyone is complaining, talking about housing costs, car insurance, and all of that being on the high side. How would you first react to this? They've also been raising rates, but it seems not to be working.
Exactly. So these are some of the policy mishaps of I mean, our economist friends will always have that kind of have the opinion, especially those who belong to the monetary theory. They believe that in order to curb inflation, we need to tighten monetary policy, and by tightening monetary policy, we need to like increase interest rates to curb the level of demand in the economy. But in most cases, it is not completely true, because excess demand or excess mobility of cash in the system is not the only driver of inflation in every economy. And the case in point is Nigeria. I mean, for Nigeria, you see that despite the fact that the central bank has increased rates by almost 700 basis points to about 18.25, inflation still continues to trend higher. right? At the last month, we are in the region of 22, and for the next month, we're looking at 23% upward. So raising interest rates is not, the primary or the only tool that can be used to address inflation. You must also understand what are those factors that drive inflation and in the economy. And for Nigeria, most of the factors are cost push factors, right? Cost push factors. Just to decompose that a little bit, you understand that for our inflation basket, food accounts for a significant chunk of the basket, right? And in Nigeria, we are having food shortages, right? And this can be due to both planting and seasonal factors, I beg your pardon, but the structural challenges in the economy, for example, insecurity in the food producing regions, also the fact that we depend largely on importation for most of our food items. So we have, instances of imported inflation that is affecting the prices of food generally. So these are some of all these, push factors that increasing interest rates cannot really address. So we may need to start rethinking the way we want to address spiraling inflation and looking at other ingenious means other than increasing interest rates. And I mean, for the US as well, you see that in the US, the Fed has actually, to a great extent, achieved its inflation objective because they've been increasing interest rates since about 11 times now. They're currently at 5.5% levels, right? And inflation has moderated from as high as 9.1% to 3.3%, which was reported yesterday. So that's a much more effective market, right? The market has the transmission mechanism of monetary policy, and then the real economy is pretty much strong in that part of the world. But in Nigeria, that mechanism is actually, not even existing because begin to raise interest rates at the expense of the economy. You are stifling economic activities. You are making it difficult for businesses to accept funding. And these are some of the major factors that we need to actually drive the economy to a progressive state. So I think, like I mentioned earlier, we have to rethink how we want to achieve a lower inflation in Nigeria in the short to medium term.
Short to medium term. We expect inflation figures out sometime next week as usual. And we already have projections that, of course, it's still going to go higher. What are you thinking? And do you think that the MPC, if they go to that round table, are they going to come out to increase the rates again?
Yeah, to answer your first question, I mean, we expect, our view is that inflation is likely going to go higher. And this is largely going to be, driven by both, food component and the core component. For food inflation, we expect that the pass-through effect of these policies will begin to manifest in higher, commodity prices, food prices, because, for the food items, we expect that higher logistic costs, storage costs, energy costs, transportation costs, all these things are going to filter into the pricing of food components in Nigeria, and that is going to, push food inflation upward. And for the, core component as well, we still think that the same upward trajectory will be maintained. So, despite the fact that we are entering into harvest season, whereby prices of agricultural commodities are expected to moderate, we still think that the impact of the PMS, subsidy removal and this rising, FX, dilemma will actually have a negative impact on pricing. So we forecast within the range of 23 to 23.5% for the month of July. And in terms of how the MPC is expected to react to this, fundamentally, we do not see the MPC increasing interest rates at the next or subsequent meeting, because globally we are getting to a period whereby central banks are already reducing the frequency and the magnitude of interest rate hike because inflation seems to have been completely moderating. So in Nigeria, we think that the central bank is expected to take a cue from that and also look at other accompanying factors, such as addressing inflationary challenges outside the realm of monetary policy. I mean, we've seen the central bank take moves to control the amount of liquidity in the system. We saw them issue homo bills yesterday, which is the first time in a long time. So we think that they will still look at other quantitative, approach to tighten the monetary, system rather than increasing interest rates at the next, MPC meeting.
Very, very, very great talk. But let's wrap up on this note. We expect an increase in minimum wage, at least to cushion the effect of subsidy removal. Government is actually working with the labor unions, of course, to arrive at what will benefit both parties, at least, government and the labor union. If that happens, many already say there will be an impact on inflation. So what are you thinking moving on as we move towards the end of the year, if this happens?
So if we have a situation where we increase the minimum wage in Nigeria, although we might have some, marginal impact on price pressure, but I think the greatest worry will be from the fiscal point of view, because if you break down how the government spends, most of the money it gets, most of the money is, channeled through the recurrent expenditure, right? And the recurrent expenditure accounts for a significant part of the total expenditure. And recurrent expenditure are used to service salaries and, what have you. So we are already spending so much as a country on paying, salaries. So if you have an impact where we increase the minimum wage by, let's say, 80 or 100%, we should expect that that increase will have a significant impact on the government's fiscal position. So most of what the money is been saving from the subsidy removal and what have you will then be channeled through this, channeled to the recurrent expenditure. Meanwhile, where we really want money to be flowing to is to the capital, expenditure to like shore up infrastructure in the country, so that over time people can begin to get jobs and their standard of living will be improved based on increments in economic activities. But that is not to say that the people do not need some level of cushion as we speak. They actually need it. But if it is going to impact inflation materially, I don't think so, because the last time we increased our minimum wage from 18,000 to 30,000, we did not see a significant jump on inflation levels. But on the government's book, I think that would have a significant impact on the government's fiscal position, given the fact that most of our monies are channeled to recurrent expenditure already.
I must thank you so much, Mr. Babajide Atolagbe. Interesting conversation with you as usual. He's a portfolio manager with AfriInvest West Africa. Thank you so much and have a great weekend.
Thank you.